Thank you so much for joining us today for an introduction to New Frontier. I'm Margaret Sargent. I work on our marketing team, and I'm very pleased to be joined today by our CEO and President, Dr. Richard Michaud, who will be providing an overview, a look at New Frontier's investment philosophy and process, as well as a sneak peek of some very exciting new research that he's been doing. Just if you have any questions, if you can submit those using the chat feature of GoToWebinar. Your lines will be muted for the duration of the call just to reduce ambient noise. And at the end, we will have a Q&A session where we will address any questions that have been submitted. And we'll also have a few updates from marketing as well. So without further ado, I will pass things over to Dick.
Thank you so much, Margaret. Thank you all for joining us in our seminar. It's an introduction to New Frontier, global multi-asset ETF model portfolios. We have standard, tax-sensitive, and multi-asset income. So the presentation will be in the classic format of an institutional presentation, people, philosophy, process, and performance. Okay. Who are we? We are an institutional research and investment advisory firm. We are very proud of our research here. We are also global software providers with multi-patented software. We are institutional quantitative asset managers. We've been managing multi-asset ETF managers portfolios for nearly 14 years. At the end of October will be our 14th year anniversary. We have also recently launched the NFGBI, New Frontier Global Balance ETF Index. It's available on the internet. You can see our performance anytime you feel like. Okay. We are very proud of our research. As I said, we are inventors and authors in investment technology. Probably the single most important publication was the book published originally by Harvard, and the second edition is now with Oxford University. And we include our patented technology that was developed in that text. We have many refereed journal, academic, and professional articles, well over 50 of them on ResearchGate, and this is far for your interest. So let's talk now about our investment philosophy. Okay. So our investment philosophy has to do with multi-asset, optimized, systematic, risk-targeted ETF model portfolios. So the systematic, risk-targeted ETF model portfolios, where the percent of equity risk is a measure, as we define it, of systematic risk, which is the usual way of thinking about systematic risk. We are also compound return efficient and globally diversified, and I will talk a little bit more about all of that. Okay, so our portfolios are along an inefficient frontier. It's not a straight line, it's a nicely curved line, okay? And so our portfolios are risk-targeted portfolios, and one at the bottom is 20% equity, 80% non-equity. And then as we go up the curve, 40% equity, 60% equity, 75% equity, 90% equity, and 100% equity. So these are all multi-asset, optimized, systematic, risk-targeted portfolios that we manage. Our portfolios are compound return efficient. The basis of my academic reputation for many years had to do with some theoretical work that I did on the long-term risk-return relationship, and then some publications, some early publications, and more recent one as well. And just the theme here is long-term investing is different. It's very different from short-term investing. It's very different from how people normally think about investing. And just a simple example of this is supposing we enter in a coin flip game, and I'm going to double your money with 50% probability, or halve your money and 50% probability. So it sounds like a really good game for you to engage in, right? Because 100 minus 50 divided by 2 is a 25% return. So I must be giving you free money. However, I'm sure you have noticed that a dollar goes up to 2 and then it goes back down to 1, and it'll probably do that pretty much routinely. So what you end up with is a 0% return. Long-term investing is different. Diversified strategies may often outperform over time. The key is the effective diversification for long-term investing. Long-term optimized is also short-term optimal, but not the other way around. So that's one of the mysteries, if you wish, of compound investing. And then we go to global portfolios, because global portfolios, on average at least, over the historical time periods, is the right answer for long-term investing. We want to span global investable economic value as best we can. We want to have more opportunities to add value. Purely domestic view is often misleading because you have to do with thinking about currency corrections, and there are some papers that I've written on this issue in the past. So now I want to talk about something that maybe you did not anticipate. Okay, so fallacies of professional management. In 1986, Gary Brinson and his colleagues at Chicago published a paper, and I was there at his presentation. And what he was able to do was to use professionally managed portfolio performance. It's not a back test, by the way. It's actual portfolio performance of institutions. And when he analyzed the components of the investment decision, he found that investment policy, or what's called portfolio composition, stock-bond ratio, which is an approximation to the investment policy, is by far the single most important investment decision. 94% was what this research paper showed. I was there at the original presentation, and it was a tremendous shock to the institutional managers in the conference. So the asset allocation decision has to do with the return from asset classes and their normal weights, okay? And it turns out it's approximately the normal stock-bond ratio as well. And Bill Sharp, the Nobel Prize winner, is quoted as saying, "It is generally agreed by theoreticians and practitioners alike that the asset allocation decision is by far the most important one by an investor." What this implied, and that I'm sure the audience when I was hearing of this presentation originally, professional management is irrelevant. That's a pretty amazing conclusion. Only important investment decision is the stock-bond ratio for meeting long-term objectives. Well, I'm sure you know that this particular idea has been around in the investment community for quite some time. Okay, it's an error, and that is my point. Okay, Brinson's definition of investment policy has to do with the normal return relative to T-bills. In other words, it's just the return minus T-bills that they were measuring. In hindsight, that's crazy. That's absolutely crazy. It also was approximated by the normal stock-bond ratio, so the stock-bond ratio turns out to be just as good a predictor as the normal return. Hensel's correction of the policy return allocation is a deviation from the group average investment policy return. That's investment policy return. And deviation of T-bills makes no investment sense. No wonder the return was 94%. Okay, stocks and bonds are better than T-bills in general over time. Okay, so when they corrected it in 1991, what you see is a portfolio policy, investment policy is important. Stock-bond ratio is important, but so is the funds that you select, the securities that you are investing in, and the manager that you choose. The manager does have an important effect on the performance of these portfolios. So the variance of all three decisions, when measured correctly, are all important relative to recent studies tend to be much more consistent with Hensel. Okay, well, I'm sure that some of you are thinking, well, how come I haven't heard of Hensel? Well, the world is full of interesting paradoxes here. I'm very, very sure that many of you have heard of the term called sponsorship. Okay, sponsorship is a very important factor associated with how capital markets work. Okay, now sponsorship associated with the academic theorists, they said, oh well, the capital asset pricing model is all that's really important. So portfolio management is not really that important. And we have all of the wonderful efficient market hypothesis guys who say nothing is nothing really works anyway, so why should we think the portfolio managers are adding value? And then there are other people who thought that this particular result was absolutely wonderful. The actuarial pension fund consultants who say, we'll think about your liabilities in terms of the stock bond ratio, and then by the way, you don't need anything else. And then passive managers, well, of course, we all know and love our passive managers in the investment community today, very dominant for many, many people here. They were also really thought this was a wonderful idea as well. And none other than Gary Burnson and his friends at First Chicago were particularly pleased with this result as well, because they were talking about the multi-market index, which is what made many people at Chicago very, very wealthy. The notion of professional management relevance is based on error. It is in error. I say that, and I have no problem with anybody quoting me on this. Hensel ends his paper by saying, decisions regarding active management, which includes market timing and security selection, can be as worthy of response's attention as the asset allocation decision. The challenge for us in the 21st century is to try to find effective, reliable asset management, better theory, better technology, and by the way, this had to be the right answer. So now I want to go into the process of, into the section called process, 4 stages of NFA asset management, and none of them are very, very surprising to anybody: asset allocation, risk return estimation, portfolio construction, portfolio rebalancing, and management. Okay. So fund selection. Okay, we are very proud to say that we are an independent global ETF manager. We do not choose ETFs only from the company we own. We choose ETFs where we can find the best, whether it's BlackRock, Vanguard, State Street, Fidelity, or anybody else. We look and find the best ETFs we can find. Okay, and so of course we have, as a global ETF manager, equity ETFs, domestic and international, of course, and then fixed income, government, corporate, and also international, of course. And we also have other kinds of ETFs that include gold and real estate and so on. So this independent ETF selection process, again, we're very proud of that. We are not beholden to any particular kind of set of ETFs. We trade. Then the benefits of index tracking ETFs, I hope everybody knows this, but it's not everybody gets convinced by the evidence. Especially not today in politics, I suppose. But anyway, benefits of index tracking ETFs: a diversified, low risk, low cost, tax-efficient funds. Only U.S. ETFs are tax-efficient funds. It's very, very important. It's a big difference between the, ETFs and mutual funds. Efficient investing for global risk premiums, that's how we use it, and it's, from my perspective, it is the modern way to invest. And we, as an independent ETF manager, we look at everything: representativeness, liquidity, fees, trading strategy, you name it. We put a whole lot of effort. The investment committee meets once a week, and we put a lot of effort into looking at new ETFs as well as old ones. Okay. The next level is risk return estimation. Now, this is a much more complicated subject, and I'm going to just briefly talk about it here. Risk return estimation is one of the most difficult things to talk about because it's really tangled in all kinds of issues. We use capital market data, for example. We use statistical inference and a number of different techniques that we use. We use something called statistical conditioning, which, for those of you who are analytically oriented, it's Bayesian methods and so on. We look at global market risk premiums, current market information, and we claim to have, hopefully it's true, institutional quantitative expertise. Both Robert and I have been on investment policy committees in the past, as well as here, of course. And we have a number of ways in which perhaps we can justify such a claim. Anyway, we start with current information, capital markets structure. Capital market structure has to do course, with the stocks beating bonds most of the time, small cap beating large cap most of the time, that kind of a capital market structure, real estate versus T-bills and that kind of thing. We use historical data. We use all our modern statistical methods that we can find, and we end up with risk-return estimates. So that's the process that we go through. And then finally, once we have the funds we want to invest in and the estimates of risk and return that we want to use, and then we go into portfolio construction. Prior to Michaud's 1952, what did finance theory look like? Security valuation. Our great friends Graham and Dodd and John Burr Williams, that is what finance looked like prior to 1954. It was not portfolio focused. I consider the birth of modern finance to be Michaud in 1952, a Nobel Prize in Economics, 1990. In my view, an extremely richly diverse, a Nobel Prize that was richly deserved. So in 1952, there was a guy named Harry Markowitz, a brainy PhD student, and looking for a thesis on the stock market in the business school at the library of the University of Chicago. And he asked an interesting question for somebody with such a mathematical background and such a brilliant man. He asked such a simple question: how do informed investors think? And he started to realize that informed investors, not just the people on the street, but informed investors are the institutional mutual fund managers. So he investigated what mutual fund managers do. Okay. And he examined their work, and he found that there were three things that characterize their behavior. Three axioms, as I call them, of modern finance. That is what I call them. Diversified portfolios. All of the portfolios were well diversified. They vary with risk depending on the client. So some clients had more risk aversion, some had less. So there were risk-varying diversified portfolios, and all of them were bounded portfolios or long-only portfolios. So Markowitz thought about all of this, sitting in the Chicago library, and he said it came to him almost all at once. He said, I was looking for a mathematical model of institutional behavior that was consistent with the three rational axioms. And at that point in time, he invented the Markowitz mean variance efficient frontier. And I'm sure everybody has seen this many, many times before, but it still remains something of an enormous milestone in the history of ideas, intellectual ideas. So you have portfolios that have more return for the same level of risk or less risk for the same level of return. And at that moment, he invented modern finance theory, a mathematical framework for informed investor security pricing in large capital markets. But what he also did is invented quantitative asset management, because he created a framework for the fact of being able to mirror how the institutions manage portfolios. And then he also defined the central investment concept of finance as the portfolio, and portfolio risk management as the objective. Think about how far away we were from Graham and Dodd and John Burr Williams at that moment. The mean variance efficient frontier is a universal framework for portfolio choice. People don't realize it, but different parts of the efficient frontier, different risk habitats have to do with value investing, low vol investing, real estate investing, fixed income investing. High risk has to do with growth stock managers, small cap, emerging, and other things. In the middle of the efficient frontier, you're talking about large cap, domestic, foreign, macro, things like that. What's mean variance efficient frontier optimization has been the institutional standard for more than 60 years. Theoretically correct, given correct inputs. Promise of optimally diversified portfolios. Commercial asset allocators to this day and optimizers to this day are just, in many, many cases, disguised various versions of Markowitz. So we have the promise of effective portfolio optimization. And strangely enough, in spite of the wonderful idea that Markowitz came up with, there are people today, many institutional-oriented managers today, they define a bond portfolio, they find a stock portfolio, and then the investment, the risk level they choose is like 60-40. But what that means is 60% in that stock portfolio and 40% in that bond portfolio. If you happen to be more risk-seeking, you could have 90% in that stock portfolio and 10% in the bond portfolio. Or if you are very risk-averse, you could have 20% in stocks and 80% in bonds. It doesn't matter what kind of investments you have, and depending on your risk aversion, that makes absolutely no investment sense. And so this is the market-efficient frontier, of course, and what we have, of course, is more return for different levels, same level of risk, less risk for the same level of return, or, as importantly, the portfolios that are riskier. They have more of the risky assets and less of the less risky assets, and vice versa. So this had to be the right answer, except for one little problem. It doesn't work. I had a Grave and Todd scroll for this paper that continues to be widely downloaded in the investment community. All optimizers, not just the Michaud's, but all optimizers don't work. But let me explain it to you with the Michaud's optimizer. So the small changes in the inputs are large optimized changes, okay? You get poor diversification, hard to manage, very poor performance. It's very hard to manage the Michaud's optimization, okay? And so I'm going to take 10 asset classes. This is all very standard data from Ibbotson and some other people perhaps, but mostly Ibbotson. And I'm going to take 30 years of historical monthly returns, and I'm going to plug them in the Michaud's optimizer. And what I'm going to have now is a composition map, and let me show you what it is. So at the bottom of the efficient frontier is the same as the left-hand side of the composition map. The top of the Michaud's efficient frontier is on the right-hand side of the composition map. And so what you see are color-coded allocations associated with individual securities in the Michaud's efficient frontier. And I've done this a few times, as I'm sure you probably know, and that is so that on the left, right at the bottom, that was money market, and this was intermediate fixed, this is long-term fixed. And for this 30-year period, small cap value pretty much dominated quite a bit of the efficient frontier. So that's a Michaud's mean variance efficient frontier, theoretically optimal under the assumptions, okay? Just two assets in the middle of the efficient frontier. Almost every part of the efficient frontier has no more than 3 assets represented. There's no way you could show this to a client if you're an advisor. And surely, this is no way you would ever want to show this to an investment policy committee, although I happen to know some people who have tried. and they didn't, the career risk was quite severe at that point in time. But most people are smart enough that they want to continue to be employed. So what do they do with the Michaud's optimizer? Well, that's pretty clear. You manage the inputs. Okay, you change the inputs. You find a new set of data. You just write in the numbers if you have to, okay? Or you constrain the solution, okay? So not too much of this, not too little of this. Pretty soon you get a perfectly acceptable portfolio that your client loves and the investment policy committee thinks is greatly deep investment wisdom, okay? And we call this a why bother optimization. You knew what you wanted. You just found a way of getting what you wanted. And you just might as well have just written in the data. And there's nothing more to it than that. And most people may be surprised. My claim is that this is what everybody does, okay? This is what even the most sophisticated asset managers do. It's all just disguised active management. I call it a scientific veneer for an ad hoc process. So what's the real reason? Why is it that all optimizers don't work? Optimizers assume 100% certainty in the data. Now, it may be a little surprising to know if you're not an electrical engineer or something like that. The computers store data to 16 decimal places, okay? Well, what that means is the computer thinks that your data, that your S&P 500 forecast of 10% is actually 10% plus 14 trailing zeros. And maybe you didn't quite mean 10% with 14 trailing zeros. Maybe you meant, eight trailing zeros, or maybe 5 trailing zeros, maybe 10.12 or something like that, But no. The computer thinks it's 10.0, 14 trailing zeros. And what about the correlations? Does anybody know correlations to more than one decimal place? I don't think I know anybody who does. Okay, so no investor is 100% certain the forecast is 16 decimal places. It's absurd. But the optimizer thinks you do. Okay, which is the reason why these optimized portfolios don't make any investment sense, and that's why they perform so poorly. So the idea is to include input estimate uncertainty in the optimization process. So this is where it gets a little technical, and it's absolutely necessary because we get a patent on all of this, and we had to do something that was a little different from what everybody else does. Anyway, we began with our original mean variance efficient frontier and our best risk return estimate. So we did all we could to get the best return risk estimates, and we computed the Markowitz efficient frontier. And that efficient frontier is the red curve right here. Okay. Now I'm going to use something called Monte Carlo simulation. I'm going to take our risk return estimates and Monte Carlo simulate new estimates that are consistent, mathematically, statistically consistent with the old estimates. But thinking about this in terms of pure investment issues, you know that your estimates have uncertainty. It is always possible that the next time you look, stocks won't beat bonds. It is always possible, as it is right now, that the emerging markets will not beat large cap securities. It is unclear whether real estate is going to do better than long-term treasuries. There's a lot of uncertainty about estimate and investment information, more so than any other field in social science. Okay, so we're going to Monte Carlo resample. It's called resampling, a particular kind of Monte Carlo risk return estimates to simulate thousands of possible mean variance efficient frontier scenarios. Okay, all of these efficient frontiers are statistically equivalently optimal by definition with respect to the original mean variance efficient frontier. It's a way to capture uncertainty investment information. That is what this procedure is, and we're using it for finance. And what it's trying to say is that there's hypersensitivity to estimation error in computer in mean variance optimization. Let me say quite boldly here, there is no hype in this. Estimation optimizers are hypersensitive to estimation error. The statistically equivalent efficient frontiers that I showed you, and by the way, I just want to say a couple of more things about it, okay? So these efficient frontiers, some of them have much more return, some of them have much less return, some of them have much less risk, some of them have much more risk. So I'm sure some of them have, if we did enough of these, bonds would beat stocks. And you'd have a whole lot of other kinds of things that people normally would not be forecasting, nevertheless, a part of these efficient frontiers. So it includes many black swan scenarios. I love it when people talk about black swans. If you simulate enough efficient frontiers, you'll get all kinds of black swans all over the place. Fat tail distributions, all kinds of tail risks, downside risk, upside down risk, any kind of risk anybody can possibly imagine in an academic paper. Somebody that has too much time on their hands, periods when bonds beat stocks, whatever. Okay, it's a demonstration of the enormous. This is very serious now, of the enormous sensitivity of mean variance optimization to estimation error in the mean variance optimization. How can managers manage so much instability and ambiguity? Think about the instability and ambiguity of this thing. It's not the inputs; it's the optimizer. And it's always been the optimizer, ever since Markowitz invented the mean variance efficient frontier. So the Michaud efficient frontier is something that I invented with my son and co-author back in 1998 when we wrote the Harvard text together. And the Michaud efficient frontier is a U.S. patented averaging process. Basically, going back to this picture, averaging all of these efficient frontiers. And the trick of averaging efficient frontiers was pretty obscure when I first started thinking about it. But anyway, this is a U.S. patented averaging process. It has optimal allocations relative to many investment alternatives. It includes all kinds of tail risk, back swans, and so on here. And it's an efficient frontier that did not exist before. For those of you philosophically inclined, it is truly, by definition, truly an invention. It is something that did not exist before, and it is not part of any natural process. And by the way, it's much more than that. It's not just for portfolios. It's actually for signal detection, noise under constraints. It's a very general procedure. Well, this is an interesting question. Is it better? Many investment banks talk a lot about new ideas, but do they ever tell you that it actually is better? Well, we try to help you to think about it this way. What do you think? This is the Markowitz portfolio's composition map, and this is the Michaud portfolio composition map. Which one would you think is better risk managed? Which one do you think is better intuitive? Which one would you prefer to go into the investment policy committee with than the other? Well, I suggest that your client might find this more interesting. The investment policy committee might find that this seems to have deeper investment wisdom than this one does. Okay? And nothing has changed, just simply the procedure of optimizing the portfolios. Now, I wanted to show you what this is all about. Okay? So this is a GIF. And it's a GIF of, actually turns out to be 50 simulated efficient frontier portfolios. So the display at the top here of the graphic here has to do with Markowitz mean variance efficient frontiers. And what we're doing is Monte Carlo simulating the returns, the risk return estimates that we began with. And it's just always the same risk return estimates. These are alternative ways things can happen that are consistent with what you thought you knew best. Okay? And you can see from this how much unbelievable instability exists in the Markowitz mean variance efficient frontier. And by the way, again, it's not just Markowitz, but nevertheless, it's Markowitz is a part of our example here. And so I'm simulating 2, 4, 5, 7, 10, until about 50 of them, and you can look at how the allocations change as you go from one efficient frontier set of risk return estimates and to another. So an enormous amount of instability and ambiguity. And which one should you use? That's the problem with them Markowitz. You don't know which one to use. So in the middle display has to do with the Michaud averaging process. And what you see as we increase the number of simulations that we take into the averaging process, pretty soon the composition map starts to look pretty stable and pretty unique. And if we had done this not only for 100 frontiers, but 50 frontiers, but 100, 1,000, or 10,000, you'd be looking at paint drying. That's basically all you would be doing at this point. The efficient frontier becomes very, very stable and very, very unique, and so on. And at the bottom of the displays here, when we get a chance to see it start again, you'll see how the Michaud solution gets created. So right about now is going to recycle once more. Okay, so that's the first, second, third, fourth, fifth averaging process. And as you can see, the Michaud efficient frontier becomes more and more stable, and as the number of averages occurs. Instability and ambiguity have been resolved with the Michaud solution. And we also have a simulation proof in our book that shows that there can be its enhancement to the Markowitz solution. But if you don't believe Robert and I, the world's authority on optimization investigated our solution and said, Markowitz says Michaud has built a better mousetrap. He had a number of different tests, and to his big surprise, he never was able to improve on that solution. So this is a fairly significant event in, I think, the history of ideas. One final thing to talk about, asset management is very simple. Okay, you build a portfolio and then you have to rebalance it, and that's all you have to do. And people pay you a lot of money for doing just something so simple as that, right? But you want to try to get it right. That's the biggest part of the problem. So when to rebalance a portfolio? Well, how do people do it? Calendar rebalancing is really much of the standard for people. And at the end of the month, at the end of the quarter, at the end of the year, at the end of 3 years, or 5 years, or 25 years, who knows? Or at the end of every 2 seconds, or every 5 minutes, or whatever. That can't be optimal, can it? And other people have something that they think are more sophisticated. They have an asset weight hurdle range, so that if you have a normal weighting for some asset and it moves, it ranges outside that range of normal weighting, you rebalance the portfolio relative to some neutral or optimal portfolio. There's no theory to support either one. None of them are portfolio-based rules. You are often trading in noise. You're trading when you shouldn't, and you're not trading when it's useful. It's one of the reasons why active management doesn't work. It's one of the most important reasons why active managers do not do well with respect to benchmarks over time. It's another reason for the ineffectual asset management practice. So New Frontier has patented portfolio rebalancing tools. And it's based on a very different notion. Is the current portfolio you have fundamentally statistically similar or different to the portfolio you think is currently optimal? Is the portfolio you have very different or very similar to the portfolio you have? And if you can say it's statistically the same, it's not going to perform any differently than the one you think is optimal. No need to trade. On the other hand, if statistically it's different, then you probably should consider trading. The first practical portfolio similarity test was the one I described in Chapter 7 of the Harvard book. Okay, it computes a need to trade probability. There were academic solutions to this problem, but they were not practical. They could not be used for practice. This is the first practical portfolio similarity test in history. Okay, it's a portfolio distance function relative to optimal, and we have improved it tremendously with Robert's help and David Esch's help here in the firm. Every optimal portfolio is an average of properly associated simulated optimal Lockwood's optimal portfolios on the Michaud efficient frontier. So every portfolio on the efficient frontier is an average in portfolio space. By the way, that's very important to say because there's some errors associated with this in some papers. This is in portfolio space, an averaging process. And now the issue here is this new portfolio that you currently have, which is not optimal. Is it close enough or not close enough? How similar is it to optimal? If it's similar enough, don't trade. It's avoid trading with noise. On the other hand, if it is dissimilar enough, trade when effective. This was a very hard problem to solve. It turned out that we found a way of solving it. The portfolio is a portfolio-based process. Again, has to be that for it to being right. It's not calendar or asset-based. Just a couple words about performance. Okay. Tax-efficient investing, we use tax-efficient ETFs, as you know. As a consequence, there's rarely any issue with capital gains, and no taxes from actions of other investors, unlike mutual funds, of course, which do have that effect and are not tax-efficient as well. So we have a low turnover strategy, which minimizes short-term capital gains as well. And long-term tax optimization is that we do have optimization technology in the procedure that does try to minimize to some reasonable way tax issues. And we're not simply substituting municipal bonds in this process. Okay. And one final thing to say is that we are very proud that we launched the Global Balanced Index, NFGBI, back in December 2017. Now, what this is not a back test, right? It's our actual performance over this nearly 14-year period in index form. So you can compare our performance as an index to any other index. You know, the trouble with comparing performance to indices, an index is not something you can actually invest in, right? So this is an index to index comparison, and I think you'll find that we do extremely well with respect to any other index that you can find with respect to our objective. This is a unique benchmark from many perspectives because we are using a 60/40 benchmark portfolio. And a 60/40 benchmark, as you know, is the institutional benchmark for many, many big institutions, but it is also an advisor benchmark as well, because most advisors end up recommending stocks and bonds and so on, and it ends up being pretty close to a risk-targeted 60/40 portfolio. And it's an awful lot like the S&P 500, which you, of course, you know is actively managed. But unlike the S&P 500, our benchmark is for global investors. So it's very much like an S&P 500 for global investors. And we like to think of it as being a great showcase for our unique investment technologies. And we have Energy BI on Bloomberg and the Morningstar ID. And you should know that we plan to have many of our other strategies as an index in the near future. With that, let me quickly summarize. We are globally diversified portfolios with tax and cost-efficient funds. We have 6 systematic risk levels. Short and long-term optimal always. Unique multi-pattern technology for today and for the long term.